Welcome back. It's Friday, and you know what that means. It's time for another episode of Account-Based Friday. We got a special guest joining us from California this morning, early morning, Matt Harney from Cloud Ratings. If you don't know Cloud Ratings, and I've got some of the merch here of Cloud Ratings, Matt does an unbelievable analytic job of really keeping track of all elements of the funnel, top of the funnel, mid of the funnel, bottom of the funnel, on the other side of the funnel. And I really look to him in terms of guidance overall. But before we get into today's conversations, first, let me just reintroduce my co-host, Meg Hewer, who's a former CMO and also former head of research at Serious Decisions. Meg and I have done over 300 plus episodes of go-to-market best practices. We've got a QR code in the upper corner here of our display that will bring you right to those 300 episodes. You can like and subscribe. Of course, if you have a specific question, you can certainly ask us, but we would encourage you, if you have a specific question, to ping one of us or like and subscribe to our YouTube channel. You can also ask questions of Matt. He's going to be presenting today some of the analytics around EBSTA and Pavilion and some of his own analysis. And we're going to dig a little bit into AI as well. It's really fascinating information. And we're really building off of last week's conversations that Ray Rike of Benchmarkit shared with us last week. So this is kind of a continuation of that dialogue. So with that, Matt, I'll turn it over to you.
All right. Well, I'm really honored that you have me pontificating and that you showed my coffee mug. Glad to see the swag does not go to waste. And as always, I always have a lot of content, right? That's just my style, and I'm going to try and get into it quick. And we'll go with the slides here.
And maybe first, Matt, I'd love for to tell us a little bit about your work in Cloud Ratings. I think you are doing some really cool stuff.
Yeah, for sure. And my background and how I came into the software industry was actually as an investor in private equity, and just fell in love with the industry, and have been investing in it for 15 years with a very analytical orientation, and truly as a passion wanted to start an analyst firm. And so I created Cloud Ratings. We have a practice area called True ROI, where we work with software vendors and buyers quantifying the ROI of products. And we're actively involved in value engineering, in sales cycles. One of our clients right now, as an example, is a Series A AI company, and we're supporting them on 7-figure deals where very large enterprises want some analytical support, some third-party validation to make a big bet on software, particularly with an AI company. We are an analyst firm. We do have quadrants, and a lot of that is enabled with a partnership with G2. So very analytical focus there. We have various indices like a demand index, an employment index, coverage of AI, and a little bit more opaquely, some of that index work is leading into us building out a data science practice. Working with investment firms where we're working with massive data sets, top of the funnel, middle of the funnel, post-purchase, trying to come up with like even more advanced ways of covering the industry. And I have a newsletter, I have 2 podcasts. So I try and keep myself busy.
I guess so. And it's high quality stuff. And I appreciate the approach that you take and the care that you take to share it, which is why I'm excited for you to get into this kind of recent study. Tell us about the study and some of the findings, because they're fascinating.
Yeah, this is an ongoing report from EBSTA. EBSTA's revenue intelligence platform. So forecasting, just building through, predictive analytics for your sales force. And they do it in partnership with Pavilion. I think they've had it for 3 or 4 years now, and I've really enjoyed it. And it just debuted. I think the key takeaways were the win rate, quite concerning to me, at 19%. And so like the initial look at a slide like this is concerning. But when you step back and look at the MQL to SQL ratios, lead volumes, and then other things not captured on this slide, was actually pretty positive. Now there's real implications to that 19% type win rate. And we've cross-verified that, cross-checked that with certain data of a private equity portfolio of like 30 companies. I know your friends at Bench Sites and Winning by Design. They're benchmarks that we encourage people to, kind of participate in, and it's kind of give to get. We'll show you a figure like that in the very low 20s right now, and that's been a real decline. And so what that means in terms of like pipeline generation, and also other ways of looking at in terms of like industry saturation, getting too far outside of your ICP, there are real concerns. And then another area I really focus in on is this velocity delta, which is measured as the sales productivity per day of the top sellers versus your average sellers. And that 11x delta, and other things around that, 78% of sellers miss quota within a quarter. 14% of reps generate 80% of revenue. Like again, 14% of reps generate 80% of revenue, and like the implications of that. And I focused on the velocity delta very much as like a new check engine light, in terms of if your whole revenue number is being carried by these very top performers, by this top 14%, like the embedded risk in your forecasts and your business model is like incredibly high. Like just as an example, these top performers arguably like know the market better than the CEO and CFO. Like they're truly in the marketplace every day, and they very quickly can realize like, hey, I've had a great 3-4 year run, but I've maximized my territory. I've sold to every financial services or telco company, right? I'm moving on to the next thing. And you lose one of those sellers, right? All of a sudden your forecast number is greatly at risk because they've been carrying the business. Guy Rubin, the CEO, we did a podcast around this report, and he noted some of this is due to churn at the seller level, right? That what we've witnessed, and you can see it in headcount data, is lots of quick and repeated churn and firings of sellers, right? You're cycling through the B and C players, and they're going to be B and C players at the next firm. And so the top reps who are there and fully ramped, have an extra advantage when you look at a ratio like this. So maybe we'll pause here before I get into my very long-winded AI, if you guys want to do it that way.
Sure. I had a quick clarifying question. If you could go back a couple of your pages
Sure.
of your deck, back to the gauges around that one. Yes. This to me was a fascinating slide, and I was trying to understand the deals slipped piece, particularly as it relates to this environment that we're now all in, that we didn't anticipate, but this probably didn't, accommodate for that. When there's a green 30, like how do I interpret that deal slipped percentage?
So that was an improvement where like a smaller proportion of deals slipped, only 36% slipped, which is not great, but it used to be 44% last year.
Okay, gotcha. So, and that was an improvement through when, like maybe January or February kind of time period?
So this would really be, I think when you look at, the report titling and everything, truly 2024 versus 2023, right? Like the 2025 report covers 2024 and things of that nature.
That's helpful. So what I'm hearing you say is things were actually getting better. They were actually improving, and maybe they still are improving this year, but it's hard to, I'm trying to discern the noise that I hear from the news from what's actually happening, although I can see it even in our own business where there's been a bit of a pause for sure. So I would anticipate that the deal slippage will increase.
I would say so. And and maybe we'll just while we're discussing this, but we're not going to get into every slide. I really do think this is like a noteworthy call out for your audience, for everyone, is this theme of AI contributes to uncertainty. We have this call out from Asana, the project management system most people know, on their earnings call. The CEO made a good point that people have these investments in digital transformation, but now they're also thinking, hey, what if whatever comes out completely leapfrogs what we're buying today? Like, why make a decision like this if something else, some unknown AI, some unknown change to how our business runs thanks to AI, is going to completely leapfrog this kind of core SaaS non-AI decision, right? And pretty much everyone's working at mature software companies, right, who are not AI natives, just started 2 or 3 years ago, and having to compete with that uncertainty, and it creates a lot of paralysis in its own way. And we've seen that with data from Xylo, which is a SaaS management platform. Basically, your SaaS spend is governed and managed and visualized through their platform, and it's very enterprise focused. And the proportion of multi-year deals has declined like very dramatically, particularly when you think through like renewal cycles and cohorts. Like, to see the number of multi-year deals declining, even though there's like financial disincentives to shorten your deal durations, right? And that tells me like there's really broad evidence of uncertainty. And then there's some like more minor nuances, right? And we see this in the very small business, but we buy AI and we test AI. It's a lot more work, right? Like, there's things we have to worry about: security, data governance, just true user R&D, because that's a huge theme to all of this. Is these tools really require, like, internally the user, the buyer, to test, and learn and iterate, because the first 2 or 3 queries you do might not work, but that 8th and 9th, and you might stumble into how this is actually going to work for us. But from an evaluation cycle, right, if things take 3 times more work, 4 times more work to due diligence, right, you fundamentally have less time available to evaluate core SaaS solutions, right, or things that are number 4 through 7 on your list, right? You're fully booked. So overall, I think a big theme is uncertainty from AI, and maybe John or Meg can speak to how out they're seeing that as well.
Yeah, I think you're exactly right. I think there's a ton of things contributing to uncertainty right now, and I think AI is definitely towards the top of the list. In particular, I think you've got people wondering what they need and what they don't, because they don't fully understand the implications of what AI can do. So as you say, that's going to say, well, I'll keep the lights on with what I have, but maybe I'm not going to be investing in other categories right now while I figure out, what I'm going to do next. And I did want to acknowledge Whitney's comment in chat. She's, she, I think, was thinking about that instead of 80-20, 80-14 rule that you've uncovered for sellers contributing, a small percentage of sellers contributing a huge share of revenue. And I would just also comment on that. I think when companies look at their 80-20 rule in terms of customers and salespeople, there's a lot of risk tied up in a small number of customers and a small number of sellers, and the wheels can come off that bus really easily. So Whitney, I think your point is well taken, right? It's how do you think about keeping those top reps? And I would also say, but more importantly, how do you get more reps that aren't the top reps to look like the top reps, to perform like the top reps? And why aren't the other ones performing that way? And if you're just cycling through new people all the time, whose fault is it? Right? Is it that every person you've hired isn't a good seller? I doubt it. Something else is going wrong if you've only got a few people who can succeed. And what can you learn from them? And is it something else that's not to do with sales at all? But I think, but Whitney, thinking about how do you hold on to those people is a really important point. Is that anything you get into, Matt, in terms of seeing what companies are doing to help with hanging, help with encouraging those reps who are outperforming to stay?
Not specifically.
Yeah.
I think like some of the thing, like when we look at it for like the publicly traded companies and certain benchmarks around that, and certain like headcount analytics, we look at, there are real advantages to having those sellers in years 4 and 5 and growing these deals and it's a real advantage. I think like generally speaking, like we see like a fundamental gap we see when we look at data is these best in class public companies are just radically better than everyone else when it comes to lots of things like that.
Super interesting. Well, going back to your work around AI, tell us a little bit about the study that you've just recently shared, and people can get access to it, by the way, which is one of the nice things about your work, Matt, is people can see it and learn from it. Tell us about some of the things you're seeing.
So I'll try and just go through the whole slide deck very quickly. Some of these are quite quick that we all know AI is getting better, and we can see that both in terms of like our day-to-day experience, at least for me, and then on some of these model benchmarks. OpenAI has gotten 3 times better. Elon Musk's XAI got better, 3x better in 1 year on a kind of model benchmark basis. I've tried to add a little bit of value here, translating what some of these things mean. That these days you can get a benchmark score equivalent to a high schooler to write you a book for 8 cents. You can get a PhD to write you a book for 75 cents. The costs are declining 90% every year. The most important thing for broadly the industry, everyone other than the model builders, is the price performance frontier is actually now at the open source level, that you can get like excellent things from Meta. And that means we're going to be able to see AI more broadly in more software tools. And it's going to be great for the economy as well. Now, and I know John is a loyal reader of this one. Our viewpoint on broad-based trends on the buy side, top of the funnel, interest in AI, category level, people looking for supply chain AI, manufacturing AI has been quite strong. That's in the top left box. Top right box, you can see for a basket of AI natives, when they catch lightning in the bottle and get word of mouth, the growth is truly explosive. The more concerning or more neutral is it's relatively range bound, or whether it's like the blue chips, the Microsofts, Workdays, ServiceNows of the world, that around certain product launches, there's a spike in interest, but it never captures that word of mouth explosive interest. Even more range bound and flat in the bottom right corner for the incumbent software companies we track, which is 340, that it spiked as products launched, but there hasn't been any acceleration that you would want to see. It's been rather neutral.
Can I just add quick context to that, Matt? Actually, 2 data points. One, I was in an AI session earlier this week with some older established companies that were panelists, and also I hosted with my neighbors that a couple are also in older school companies. And what I'm noticing is in those conversations, the first one, people are very surgical in their AI use. So they're very use case specific in bigger companies in particular. Everybody's dabbling with the $20 a month kind of thing, but they're very, very specific. As an example, they'll use AI for analyst inquiries, and they'll train an AI agent for product marketing use cases around the message, and just train the agent just for that use case to really speed up the kind of the inbound inquiries. So I heard that in contrast to a few of my neighbors who I hosted at a poker party last night. They were hardly using AI at all. And, I felt like an extremist here. Like, I've got my cell phone that has AI. I've got 9 different AI apps that I subscribe to. Everybody on LinkedIn is talking about AI. And yet I had a COO of a manufacturing company a CFO of a book publisher, a general manager of the largest car dealership in the state, and they were hardly even using AI or even knew about it. So it was like, it was night and day in terms of the contrast, especially given our line of work, which I thought was really interesting. But undoubtedly, the tsunami is coming. So, they will eventually catch up to this AI. I think it's just a matter of time, to your point. But there's still a whole section, at least in the US, that I was really surprised that there was just not a lot of traction with AI.
That's good context. I think we'll kind of hint at that with some broad-based data a little bit later. But
Interesting.
that lines up with, I think a lot of us in the LinkedIn bubble or the Friday webinar bubble might be ahead of the game relative to
100%. Yes.
the broader population.
Yeah. My family thinks I'm nuts for all the AI that I do, but I love it. But yeah, I think it is a bit of a bubble, and we're all like this kind of frenetic bubble in LinkedIn a little bit. So anyway, I'll get back in my cage. Keep going.
And so, and along those lines, it's very early in terms of the revenue contribution of all these things. Like Zoom Info is one of the cleanest. It's about AI represents 5% of their revenue today, right? So relative to what you hear, it's still quite small. Now there's signs on the customer side and attach rates, and you can spin these things like Salesforce and Benioff are great at marketing, obviously, and they can say 100% of their top 10 deals have AI in them. And Freshworks will tell you 50% of their new deals have AI in them. And that's kind of where we see things as 30, 50% attach rates on new deals is kind of what I would say is fair for what's being disclosed. So it hasn't shown up in financials yet, but it's coming, and the forward indicators are positive. We covered this uncertainty, and as a fundamental view and how I look at things, it always comes back to ROI. Menlo Ventures had a great study, 300 enterprise buyers. Number one criteria is easily quantifiable ROI. The good news is the ROI studies are coming in positive. Iconic Growth has shown generally 5 to 20% productivity gains. Interestingly, for this audience, marketing, one of the strongest, as well as sales. Bain has also had similar studies that 15% type gains, and that's quite meaningful. Interestingly, the gains have been the best at the largest companies. Like we're talking, 15 billion revenue and up. This study from Morgan Stanley, that they are beating expectations. And interestingly, the census covers AI usage over the last 2 weeks, and in a very high frequency range. We have it through mid-March here. And it turns out it's the larger companies, 250 and up, which is the largest in their tracking cohort, are adopting a good bit more. But kind of to John's poker group point, right? Even those leaders, about 12% are using it, right? And for everyone else, it's more like 6%, right? So still very, very nascent and early. And you also see that at the sector level, like information, which is census terms for technology, or similar things like professional, scientific, technical services are adopting, in the high teens ratio, but something like manufacturing is 2 or 3%. So like very, very, very small. Like, how should we think about all of this, right? Is this too narrow? It turns out on a task volume usage level on Anthropic and Claude, 75% of it comes from four occupations, right? It's basically software developers using it all day. But like, what about like the general population, the Microsoft Copilot style, weaving in AI 10, 15% throughout your day? Still is not happening. And then also, is AI moving fast enough, right? Technology cycles, adopt more rapidly. And we're in a post-internet, post-social media world. Should all of this stuff be moving like even faster? And what we did is we took the census data and compared it to the internet from 1995 forward and PCs from 1981 forward. And if you believe the 250 employee trend line as like the right indicator, we're on an internet trend line. We're in 1997. If you believe everyone else, these smaller businesses, we're on a PC-like trend line, and we're in 1983. Same thing when you break it down by industry. If you believe in the leaders, like information sector, we're pretty close to an internet trend line, a little bit below it. Everything else, more on a PC style trend line. I think, so much of this comes back to a concept of unbounded task TAMs, and I'll just read aloud. In some end markets, the size of the task TAM, total addressable market, is unbounded, meaning that a substantial increase in low-cost human hour equivalents would give a corresponding increase in business value. For example, software development has an unbounded task TAM. There is value to a business in creating a lot more software, assuming it is useful software. And again, we went back in time and looked at the history, right? Is this concept, like when we look at AI and this concept of more and more software, like plausible? And in fact, we've already been having that happen, right? And particularly when you adjust for quality, kind of like CPI style adjustments, and you think a stack of Microsoft Office tools, Excel, Word, PowerPoint, 1989 in today's terms would cost you $2,500, $2,500. You look at what you get for $100 per year in the Office 365 suite and how much better that is, right? And so basically, software on a quality basis has just been getting better and better and better, right? Per capita. And that trend can only accelerate is my fundamental viewpoint and when we talk about like the death of software and everyone's going to be vibe coding and there's going to be a sea of everything, like that very well might be true. But I think we also have to think about like how much better all of the tools we're using are going to get, right? How much better things can be. And that can be quite positive, right? If these tools are doing that much more, adding that much more value, from a software vendor's perspective, you deserve to charge more, right? If you're taking on more automation, replacing labor, adding business value, your addressable market and everything will increase. So maybe focus a little less on the supply side and focus a little bit more on the quality side. And then just some reminders as we all get worried or get excited about AI is a lot of it's opaque, right? Interestingly, like 50% of data in the enterprise is on premise, right? And there's inherently a lot less visibility for folks like me pontificating. We just don't know certain of these workflows or data sets that are guarded for good reason. And an example of that is one of our clients at Cloud Ratings is actually serving tequila companies, and they have built AI tools that work in agave fields, right? That is able to scan these plants, predict their growth rates, predict their health in fundamentally amazing ways. And that compares to like gut level people writing on paper pads in the field, quote unquote, data, right? And so there's all of these areas we haven't even thought of that we'll tap into. And I think we should all be excited about. Like I'm more in the we're in 1997 camp than most people would be. And I believe I've come to the end of my slides. Wow.
Well, thank you so much. That agave use case is wild. That's so cool.
Yeah.
I can see like people who grow hops or grow grapes or grow, like fruit of any kind, like testing it, and you get like your perfect, your perfectly ripe strawberries and raspberries. But anyway, um, super cool. But thank you, because I'm with you. I mean, I remember 1997. Embarrassingly, I was in business school then, but it was kind of a great moment to be learning different things and kind of getting to talk to lots of different companies and lots of different perspectives, because it was such an exciting time. And I think we're sort of there again, and that's a nice place to be. Matt, thank you for bringing all of your incredible research today. And I really do encourage people to take a look at, a number of Matt's studies with some great partners. And I think some really helpful findings. And as businesses are trying to manage through these interesting times, it's helpful, I think, to be able to go back and say, how does our performance compare to some of these benchmarks? Assuming they're relevant for your industry, because every industry is different. But if these numbers are in the right neck of the woods for you to be able to use them for comparison, it's helpful to put things in context and to be able to say, are we over, under, somewhere in the middle, and why? And I think that's where, benchmarks become a really, really powerful tool. So no surprise, you've got investors also wanting to work with you, Matt. Any, sort of last comments? And John, any last questions that you want to bring in? You're on mute.
We'll get a question from John.
Yeah, exactly. You can hear me a lot better when I'm off mute. No, this has been fantastic, Matt. Thank you again. And I dropped the link into the body so people can click on it. But let me test out a question or a hypothesis that I'm hearing more and more about, and I'll be curious about your reaction to this. First of all, at the beginning of the week, I think it was Shopify CEO came out and said very publicly, "Thou shalt not hire any more people without proving that this body of work can't be done by AI." And, as soon as the CEO says that, all the CEO peers probably look to that as the bellwether. So you have that as setting the stage. And then kind of thinking about a benchmark element of CAC, cost of acquisition of acquiring a customer. Sales cycles have lengthened here because it's a choppy environment. They were already lengthening. Now they're probably even going to more lengthen if you've got a global type sales scenario. So your CAC is increasing, and you've got all this sales and marketing, what I call excess capacity. And I call that based on a conversation I had with a PE colleague. We were talking about, like, what are the challenges here? And one of them is the sales and marketing capacity. So I guess my hypothesis is will we be tying back AI now to that sales and marketing capacity? Like, is this all interrelated? Meaning, is the way to get to the CAC that a lot of these public SaaS companies need to get to AI? Like, is that the path to shrink down the CAC, to get it to be more manageable? Or is, like, CAC not the right bellwether that we should be looking at for these public companies in SaaS as benchmarks? Like, do you have a point of view on any of that?
There's a lot of good stuff in there. I would say, you take that Shopify memo. You can look at some of this as like a forcing function, right? You need to drive a certain degree of change. And I don't think it's realistic. Like, okay, I'm going to replace my CMO with AI, but like,
Right.
and therefore we can't rehire the CMO who left type of nonsense. But it's a really good way to like sharpen your managers and VPs to like, yeah, everyone needs to be using AI every day. Like, just set the baseline expectation. You should be in Perplexity or Chat GPT. And when you want to do some analysis, you do it yourself, quickly iterate, and let's start getting that mindset and change into our business. I think that's incredibly healthy. And I think like that's like a good baseline right now is to be using AI yourself like every single day. Right. And it's like a great interview question right now is to ask people like, how are you using AI? And it can't just be I use ChatGPT a little bit. It's like if you're a emerging marketing leader or something, you're figuring out how to optimize copy or use some of this advanced tooling. People have had more than enough time. And if you have any interest, you should be, in any agency and drive, you should be taking advantage of all this stuff. I think when it comes back to like the CAC thing, I think like that overcapacity is there. I think there's plenty of things people invest in, right? That you can look at the EBSTA data in terms of the seller productivity, right? If those are the numbers and this is a pretty consistent thing, like you probably have too many people, right? Or if you're generating, and you look at the EBSTA data again, like the quality of leads and the sales velocity generated through paid advertising and events is dramatically lower than partners, right? You might have to take a hard look at like certain trade show investments. But again, it's all very case specific. It depends on what you're playing for. If you are growing to a plan that you IPO in 3 years, or that you know you're going to raise $80 million of capital and you're going to have to deploy it, like you have a path. And then if you're private equity owned and you get a very thin budget, right, your benchmarks and your growth rates are inherently different. And then I think like a consistent learning, we do a lot with the public companies, a lot of analysis with the public companies. And inherently, they have two big advantages. One, value-based pricing. They're radically better at that. They lead with ROI. They don't discount. They drive. And that also flows back up into things like CAC, right? Like the lifetime values are higher, the margins are higher. And then that brand flywheel is real. I know Ray had some data there that you can even see it start emerging at $50 million from a marketing CAC ratio, right? That you're included in every deal, you're on the short list in every deal. And that's like especially powerful at the kind of like public company scale. And then another thing that's like kind of under discussed, under analyzed is like how much leverage you get from partners, and partners, particularly at that scale. If you're a Microsoft partner, a Datadog partner, whatever, it's because you're coin operated, right? You are picking the horse, right, and doubling down on Microsoft or Datadog because you want to make money. And that flywheel just accelerates, right? And so if you are kind of tier 2, you don't have the partner channel, you don't have all these feet on the street indirectly, right? Like that gap widens. And so when you look at all of these ratios, you look at the productivity measures or what have you, there's just these like massive gaps. And I think AI in certain things that like kind of the uncertainty points, that type of thing, what kind of real world, most vendors, most people on LinkedIn or on a webinar like this at regular real world companies need to know is how much of these incremental budgets are going to be consumed by Microsoft, Amazon, Google, ServiceNow, but particularly like just the infrastructure side. So much of everything is going to be consumed by them that's going to be another headwind to like manage. So if someone's giving you a big plan to sign up for a big quota, a big growth number, a big pipeline number, like be afraid. I scared everyone a little too much with that, but I want to like be a dose of realism for like the real world organizations.
Yeah, there's a lot I think that people can pay attention to in there, Matt. Thank you so much. And I see we've got a comment saying you made someone's day. It sounds like around adoption rates, that they were feeling behind the curve, but sounds like maybe they're not. So that's good. You cheered somebody up today.
Okay, good.
Anyhow, see data doing its job, bringing joy. Anyway, thank you again for being here. And hopefully you'll come back again and we'll learn more. And in the meantime, we'll keep reading and keep an eye out on your posts because they're always super informative.
I really appreciate the kind words. I appreciate the work you guys do and putting these things on and inviting me once in a while.
It's awesome, Matt, and thanks for the product placement of Cloud Ratings. Check out.
Awesome.
I put the link in with all of Matt's analysis and AI, so grab it there, and we'll rejoin again same time next week. Look forward to having that conversation.
All right.